Building the Talent Machine is out in San Francisco, and we're about to talk to Peter Walker, head of insights at Carta.
I see the best startup employees that want agency. You're there to solve problems.
There are going to be ups and downs. I'm obsessed with what motivates people to do great work.
There's a path, and it takes time. Most of the time, that equity is not going to be worth what you think it is. It is not the same thing as cold, hard money. Cash today is worth more than cash in the future.
This brings a very realistic component to hiring. Sometimes we capture lightning in a bottle in these moments in our career. Hey, RecOps friends, are you still losing hours every week to interview scheduling chaos? What if you could eliminate the back and forth, cut scheduling time by 90%, and actually get those recruiter hours back on the hiring desk where they belong? That's exactly why teams are turning to Rooster, the native interview scheduling platform built inside Workday Recruiting that finally makes interview logistics fast, seamless, and predictable. With Rooster, you connect directly to your Workday system. No extra tools, no disconnected workflows, and instantly let candidates self-schedule with one-click booking links. It handles time zone and language differences automatically, sends branded confirmations and reminders via SMS, email, or WhatsApp, and keeps interviewers, coordinators, and candidates in sync without constant manual follow-ups. And it's not just about speed. Rooster helps you see the true cost of scheduling inefficiencies with its TAS metric, so ops teams can track and improve the parts of the process that slow you down the most. Whether your team hires locally, globally, or somewhere in between, Rooster cuts errors, saves 10+ recruiter hours per week, and creates a candidate experience that reflects the quality of your brand. If you're ready to stop chasing calendars and start hiring with confidence, visit rooster.us and schedule a demo today. Your recruiters will thank you. Now, on with the show. Peter, thanks so much for coming on the show. Thank you so much for hosting us here at Carta's beautiful headquarters. We're in the Carta Library in downtown SF. It's awesome to spend some time with you. How are you?
Doing great. Welcome to Carta. Thanks for joining us. This is awesome, man.
Yeah, this is cool. You've been putting out a ton of great content that helps empower recruiters to hire better, be more informed. There's also the employee and candidate side of learning about equity.
Sure.
In your own words, what does Carta do in that data, people, and workflow process?
The goal of Carta is to be the ERP for private capital. What that means is we connect a bunch of disparate systems that help private companies and private funds operate better. So most people know us as a cap table tool where founder would buy Carta in order to track the ownership of their company. So I issue equity to employees, I issue equity to advisors, I issue equity to investors. You track all of that and the rights and responsibilities and obligations of that equity on Carta. What most people don't understand is that we have as big or even bigger a business in helping private funds. So we manage the back office for private funds. So valuations, portfolio monitoring, audit, tax, everything that kind of sucks about being a VC or a PE investor, we help you run that so that you spend your time finding great founders, et cetera. But on the dint of that, we have right now on the platform, I think something like 1 million employees that work for private startups manage their equity through Carta, which gives me all this really cool and interesting data to play around with.
Playing with the data is exactly what you've been doing. You're a visual storyteller. You've completely blown up online because of your skills, experience, training as a data leader. How do you think those data storytelling moments help recruiters hire, develop, and retain the most talented folks in tech?
I think that data storytelling is actually something that recruiters do poorly. And there's this sort of friction between, sometimes, not for all recruiters, between like talent acquisition, orgs, et cetera, and data. And some of that is in the basic stuff like, okay, you're having a candidate conversation. How deeply can you get into like scenario modeling this equity? Or like talking to them about what 409A strike prices mean and all this kind of stuff. Sometimes legally you don't want to do that, but sometimes it's just you don't feel comfortable doing it, so you kind of avoid it. The other side is that how do you use data to illustrate the company's story? So if you look at some of the best private market companies, Anduril comes to mind, a couple other ones, they're using data in their candidate pitches to tell the story of like where the company's been, where it's going. And that brand halo that comes from this like really data-centric approach, I'm sure it makes their recruiting a little bit easier. Obviously, it helps if you have an incredible brand name as well.
100%. One of the things that popped up this week when I was talking to some of my recruiter friends is the evolution of employer brand and recruitment marketing and how a company positions itself to candidates.
Yep.
What's challenging is the market, the company is not static over time. You work with a lot of early stage companies that go through these major growth moments,
Yep.
and a seed to Series A company operates and has a different culture than
Yep.
Series B to C or a pre-IPO company.
Yep.
So when I think about the evolution of brand, it really comes down to what does your day-to-day look like in the candidate journey
Mm.
as it relates to what you do in your job.
Yep.
So when you think about a company like Anduril bringing data into that process itself,
Mhm.
how do you use data at Carta to hire for your team and
Yep.
to evolve the culture of a growing company here in SF?
I think it's really difficult to explain to people just how different it is to hire for a seed stage startup versus a Series D startup. Startup is actually a vague term. And that way we maybe use it to describe too many different things. Because when I'm talking to early stage founders, how are they going to get the first 5 employees in the door? Is that data driven? Not usually, right? You have to find people who are incredibly mission driven. They would be working on this problem for someone else if you didn't exist, or maybe even starting their own companies at that point. It's an art, not a science at the earliest stages. For some place like Carta, we're Series G. I don't actually even know what series we're at. We're very late stage. We raised a lot of money. And we use data, not just in like the compensation bands, which is probably the clearest example of the data, but also an idea around the kinds of modeling you're going to need for this role. And this is where AI is a huge impact to what we're doing. It used to be that you would model out the future of the company and say, we're going to scale these people linearly as the company grows. That's just no longer the case. You know, we are actively, when we're hiring right now, of course, but we're hiring for positions that we think are going to be augmented by AI in a way that they have never been before. So we're going to get a lot of scale leverage on those new hires. So it's not like you're keeping the company headcount flat, but it's growing a lot less than it used to, just because you think each one of these people are going to be more empowered to do a lot of cool and interesting stuff. So I think that the AI piece is, when I talk to founders and talent folks, it's the topic over the last 12 months.
Now, you're in a unique position to have access to what's happening behind the scenes from an equity distribution standpoint as it relates to headcount growth.
Yep.
Is that something you're seeing across the 60,000 plus companies that are on Carta?
Yeah, so maybe this will be surprising to some of the recruiters listening. But we have seen the single biggest change in compensation for startup employees over the last 3 years since Carta was founded in 2013. And there's 2 inputs to that. One, equity, salary, all these compensation bands shot up in 2021.
Yes.
And candidly got ahead of themselves. And this was partly due to a lot of external factors and partly due to the fact that many of these people that you were hiring had 3, 4, 5 other offers. So of course, if the offer scale, if there's some amazing BATNAs, if there's great alternatives to your offer, you have to go to the top end. Maybe you're a 50 percentile company, but you go to 75th for that great engineer or 90th for that amazing engineer. That just doesn't happen anymore for most employees. We'll talk about AI, ML engineering in a little bit. What we've seen is that equity packages, on average, are down 50% from that peak, which is a massive change to the way that equity works. And some of that is because, candidly, employees don't understand equity that well, so they're pretty terrible at negotiating for it. And some of that is companies going back to their boards, and the boards are saying, you're burning way too fast on your pool. You need to ramp that back, both by hiring less and by probably giving less equity to each individual person that you hire. So it's been a sea change.
So if I'm hearing you correctly, I was recruiting in 2021, making those offers
Yep.
to ML engineers, data scientists,
Yep.
having monster comp packages. And I think pretty common when I reflect back, it might have been, Series B, 2021 giving like maybe 0.1%.
Mm-hmm. Yep.
Are you saying now down 50%, you're seeing like, say, a Series B company in 2026 might be offering 0.05%?
That's exactly right. Wow. Yes. And to be clear, that's on average across the whole employee population.
Sure.
There are pockets where that's not true. AI, ML engineering, there's been a lot of talk about how AI is eating coding first. At least in terms of the data on the comp side, that's just not true. Like AI and ML engineers are getting paid. Their compensation is growing at a rate that no other employee base is growing. So it's still a good time to be an AI engineer. Like coding still matters. If you are a marketer and you're joining a Series B company, probably your equity package is going to come in at about half of what it would have 2 years ago, 3 years ago. The salary is up somewhat, definitely didn't keep pace with inflation, but it's up. But your equity package is much lower. And we can talk a lot about why that is, but it's a massive, massive drop.
It's fascinating to hear you say that, because when I reflect back to 2021, the timing that we're at now is maybe there are marketers out there who just hit their 4-year vest. They've hit their cliff milestones.
Yep.
They're ready to take on their next project. If I'm that marketer, it has to be a really good offer. It has to be a very strong employer brand or company that I want to hitch my wagon to.
Totally.
If I'm going to leave my current position, knowing that total cash has not kept up with inflation and equity is lower. This brings a very realistic component to hiring. Sometimes we capture lightning in a bottle in these moments in our career. What are some of those lightning moments for you as you reflect back on the career you've had, and now you've landed in this position where you're one part data leader, one part storyteller, but that isn't always how it started?
Definitely. Yeah, it's a great question. Before I answer for my personal experience, you are completely right that I think part of what's going through employees' heads right now is this calculus of why would I leave? In a way that in 2021, it was like, why wouldn't I leave, right? Look at all these incredible opportunities that I have. Now it's, well, I did see all these layoffs. I am now looking at this hiring market, and the friends that I have out there who are searching are like, look, it's pretty tough out there right now. So if I don't dislike my current job, maybe I don't love it, but it's not a bad job. The motivation to leave to the next thing, it's lower. And more people are sticking around for longer. But sometimes you catch those lightning in a bottle moments. For me, the biggest one in my career so far has been, oddly, COVID happened. I was working at a startup. I was running the marketing and data teams for them. It was based in DC, but I was out here in San Francisco. COVID happened. Everything shuts down. I do the data nerd thing, which is I get on Twitter for the first time, which is, I don't know if that's a good idea or not, but it happened. It was good for me. And I start producing data graphics on COVID data from anywhere that I could grab them, just like trying to make a sense of it for myself, honestly, just like hospitalizations, tests, all this kind of stuff. And the Atlantic magazine read a bunch of stuff that I'd been posting and said, hey, do you want to come and run this data viz team for us for this new project we're spinning up around COVID? So complete serendipity. I end up having the second job at the COVID tracking project at the Atlantic for a year. I build this data process at scale where the whole goal was, this is a highly changeable, weird data set. Let us explain it to you. It turns out that is a perfect match to what a lot of B2B teams should be doing with their own data. And so I made a list of places to do that for right after the project was spinning down, and Carta was number one on that list. So sort of like a weird MBA in this thing that I do now for Carta.
So sick.
Yeah, it was wild.
And shout out to Nick Thompson. You got to come out to Colorado and go for a run, my friend.
There you go, Nick.
When I think about what you said, wishing recruiters had a more data-centric approach to their workflow, a lot of recruiters fall into recruiting. It's one of those business groups that has a low barrier to entry. Many of the recruiter friends that I have didn't go to school to be an HR pro or recruiter. What are some of those table stakes skills or strategies that you think a recruiter can learn to upskill so that they can speak the language of the business?
I think it's becoming more comfortable with numbers in general, not just here's what the offer is and here's how it translates and here's how I explain equity. That should be table stakes, although candidly, it's not always. But more to what you said about, do you understand the way that this business is growing? Do you understand the levers of this business so that you can be a better partner to your business teams, looking out over the vast number of people that you could hire and saying, actually, based on my knowledge of what this business is doing, I think we should be investing upfront in data science that we're going to hire 2 years from now in this way, this way, this way. We need to be making our employer brand in data science really, really strong for these kind of people, et cetera, et cetera. I think it's surprising how many recruiters are treating each individual job opening as though it's this new fascinating thing, and they go out and do the LinkedIn Navigator stuff and find the people, instead of being like, oh, I can see down the road we're going to need talent in this area. I'm going to make it my job to know that talent up front, so that when that business leader comes to you and says, we're spinning up a new data science group, you don't search for names. You're like, I know exactly who we want to go to. It's actually Somebody put this on Twitter the other day. I think it's a fantastic exercise for all employees to do. You should have a list of people that you want to work with in your career. That list can be 5, 10 people.
Yes.
And if you have that list, you'll be shocked at how sometimes you actually end up working with those folks, like down the road, years and years from now, right? I have a list of 10 people that I would love to work with that I just think are killer in their fields. And knowing who they are, knowing actual individual people instead of just the best of blank is a real difference. So maybe that's one strategy to get ahead of the business needs.
I love hearing you talk about talent mapping and talent intelligence. We're seeing a lot of the senior sourcers, folks that have done technical sourcing, scraping GitHub for the last 10, 15 years. Now they're in these talent intelligence roles. They're doing deep research of markets. What are some of the data points you're seeing for remote companies, that migration of talent that maybe used to live in the city, but now they went back to the Midwest, or they went to a lower cost of living city when they had so much remote flexibility? What's happening on those comp package perspectives?
Yeah, remote is a really interesting question. If we had this conversation 2 years ago, it kind of felt like remote was the wave of the future and that every company was going to become more deeply embedded in a remote strategy. I would say, especially amongst young startups, that has really bifurcated over the last year or so. There are some startups that are saying remote is great, and we're going to structure the company around remote employees. And then there are many startups that are saying, we tried remote, didn't love it for whatever reason, and we're going to go back to in-office only. What is hollowing out is that middle. I'm not seeing a lot of young startups who are going, we're cool with hybrid to begin with. There are a lot of bigger places that are kind of hybrid by default because they went remote during COVID or whatever, and now they're in the messy middle. And if you talk to many of those CEOs, they're like, I wish it wasn't the case, but we got to keep it because we have great talent or whatever. So I think that most companies that are started from today onward are going to choose A or B on remote and be a little less flexible on the hybrid thing. This is the kind of company we are. That gets back to the employer brand. If you are a in-office company, that's awesome. You should be shouting that from the rooftops so that the people that apply are already bought into that strategy for you. You don't want to be sifting through a bunch of people who want to be remote if your company is not remote. It's just a waste of time for you as a recruiting team.
One of the things I've observed over the last few years in recruiting is companies used to spend a lot of money relocating folks. So we can find talent anywhere. We can pitch them on a great experience to move to San Francisco. We'll give them a $10,000 relocation stipend, sometimes for executives. It's massive sign-on bonuses, down payments for their new home. I remember recruiting for companies and having those lifestyle conversations with candidates, touring them around neighborhoods, taking them out to fancy dinners.
You're a real estate agent as well, basically.
Exactly. And that type of candidate experience is the foundation for my career. I just don't see that anymore. Is that accurate?
You were part of a dying breed, I think, of people who get to do that kind of thing. I will say, just as everything with startups, there's a have and have nots here. If you are, for instance, we've seen these unbelievable comp packages that come out for AI, ML, engineering, research talent for the mega labs. If you are in that category, Mark Zuckerberg might make you soup, right? As part of the recruiting pitch. If you're not, I don't think relo bonuses are down. People actually getting sign-on bonuses as an average startup employee is pretty rare these days. I mean, it happens for executive talent. There's an executive market and a non-exec market.
Right.
But in general, if you're a senior manager, you probably shouldn't expect a big sign-on bonus, maybe a relocation package if that company is really gung-ho on SF or New York. But outside of that, the sort of bells and whistles on the inbound side, they've gotten very trimmed down.
One of the challenges recruiters are facing right now is managing candidate expectations and bringing them back down to earth a little. I think we all have this drive and motivation to do incredible work, be compensated fairly, have a great total rewards system that we're striving to earn and achieve in our careers. But the career ladder is kind of a thing of the past. There are going to be ups and downs. But there's also a dynamic I observe, especially recruiting director plus talent, where at a certain point, you kind of hit a plateau and you get to a point where you're no longer striving to the next level. You're executing against what you know as your strengths. And I'm also seeing a lot of senior talent that may make lateral moves, or they may go from VP back to a director level, where we have an influx of requisitions hitting the market. It's Q1, but we're seeing an imbalance in terms of years of experience based on the cost of labor, where, to put it frankly, great talent is on sale. I hear that a lot from companies hiring, where it's like, oh, we need a director level role. And instead of hiring a stretch senior manager into that director level promotion, it's, hey, we could get this VP that's willing to take director, or perhaps it's a director level posting. They hire that VP. The VP is part of their negotiation, up levels to senior director.
Right.
I think there's a lot of fluidity.
Yeah.
What does the data tell you about career fluidity right now?
You're right to note that it is more fluid than it's ever been, and people are kind of getting trapped in little pockets. So I would make 2 points. The first is hiring in general is down, but there's also a bifurcation in the kinds of hires that are actually happening. So we have seen fewer big executive hires and more player coaches who do actual IC work and also probably manage a team on the side. So like the idea of the ivory tower manager who doesn't actually build, I think, is kind of going out of fashion. The second point, and I think that's really a strong one that you made, is so who are these VPs that are willing to take a director level job? Well, oftentimes what they're doing is they're trading company futures. So if I'm at a SaaS unicorn that made it big in 21 or 22, but isn't really growing that fast now, jumping to an AI native startup that has incredible growth prospects might be worth it for me, even if I'm taking what on paper looks like a demotion. And there are a lot of people who are looking around going, this company is getting very long in the tooth. It last fundraised 3-4 years ago. Yeah, it's growing, but not fast. Yeah, it's maybe break even, but not by much. And if you look at what IPOs today, or what gets purchased for a big M&A acquisition, those numbers don't cut it. So oftentimes you're sitting there going, okay, maybe I should take a jump, even if it means I go down one rung on the lattice so that I can move back up with this company growing.
Love that idea of trading company futures, because you think about that lifestyle motivation. Yeah. We're in San Francisco. Folks at that level in their career usually have the financial stability, the financial lifestyle milestones. They own a home, maybe they have a family, maybe they don't. And at that point, it's coming back to motivation. I'm obsessed with what motivates people to do great work and what motivates people to join startups. What do you think those startup traits are that differentiate people from going and working in one of the other 10 sectors outside of tech?
It shouldn't be, sometimes it is, but it shouldn't be comp, right? Like it shouldn't be an intrinsic, if the thing that is motivating you most is to make a lot of money, which I'm not going to neg that as a motivation, it's totally valid. Don't join a young startup. That's not a great approach. No matter how often you've heard like, oh my gosh, my buddy was at Facebook when it was young and now they're a billionaire, whatever. Yeah, it happens in this town, but most of the time that equity is not going to be worth what you think it is. I see the best startup employees and the ones that are making jumps now from prior other careers into tech. They want like 2 things primarily. The first one is they want agency. So if you're joining a young startup, you get way more agency than you even bargained for, right? So yes, you have a job title, but that's not why you're there. You're there to solve problems that are around that space or even completely separate from data science or engineering or marketing, whatever you're doing. The second one is as companies scale, there are often vacuums that suck people up into higher levels of authority that they probably wouldn't be in if they had been at a scaled company already. So if you're at Adobe, going from manager to senior manager to director, there's a path and it takes time. If you're at a young startup that goes seed to Series B in 2 years, you might find yourself managing a much bigger team or doing something completely different just because the needs of the business are radically different today than they were 2 years ago. So you kind of get, there's open opportunity and you just kind of get pulled into those spaces. I think that the people who are excited about that sort of ambiguity should choose startups, but that's not everybody. And there are a number of people that I know who chose startups and just found that it's not the way they want to work. And so they want to go back to big tech. They want to go back to something a little bit more stable. And that's awesome. But everyone should try a startup for once and maybe you'd be surprised at how fun it is.
I love this idea of solving problems. What's the number one problem that you're obsessed with solving here at Carta?
I think the biggest thing that we are trying to solve right now as a company is like making the fund CFO a first-class tenant in their own business. All of the CFOs that you know, CFO at a company, CFO at a nonprofit, CFO at a Fortune 500, CFO at a startup, they all have custom-built software that is dedicated to them because people understand how important that CFO is. They're often the biggest purchaser of other softwares in the company. Like they're a really first-class citizen within the C-suite. In a fund, CFOs are often thought of as like the back office, right? Like managers are the stars, CFOs are the people that kind of make the numbers match at the end of the quarter. We're trying to elevate them to much more strategic function. And the only way that you can do that is through software, not through people. So those are the set of problems that we're working on. If you want specifics on my job, the biggest thing that I'm trying to do right now is figure out how to make my LLMs make me better looking charts out of the box. So if someone has a great workflow for this, it's fantastic at the data analysis, but the charts themselves are just like not good enough yet. So I want better charts. As a data viz nerd who holds a high bar there, I want better out of the box charts for LLMs.
I'm an English major. I'll leave the math to you. But that's actually the biggest gripe that I have, where we're 3 years into ChatGPT now.
Yeah.
And from day one, I wanted really strong Excel and really strong data viz.
Yeah.
Those were two deficits I had as a recruiter. One of those guys that fell into recruiting, moving fast, understanding the funnel, knowing how to communicate verbally to stakeholders and sound really good. It was like, how do we get this information into a better looking deck?
Yeah.
How do we get it into a better dashboard? Because the reality is a lot of HR tech sucks. It's ugly.
Yeah.
It doesn't match the rest of the stack.
Yeah.
And it's always like lagging. And when I think about our stakeholders, if you're my hiring manager and you're logging into your HR software and it's like your 7th to 8th priority SaaS in your stack, and it looks like crap, subconsciously, you're not going to care as deeply for the function itself, or you're going to have a subconscious detraction from leaning into that information. So it's interesting to hear you say that. I also saw a chart recently that talked about the rise and slight recalibration of high math and high social skill. The 2000s and early 2010s, there was a very strong index on high math to high earnings. Now we're seeing high social catch up a little bit to that balance of high math. So when we think about the messaging in the market from education and hiring in the 2000s and 2010s when we were coming up, and it was this focus on STEM. How do we keep up with China? How do we get better standardized math scores? Math is the core to all of the software that's being built. But I'm kind of excited about this future where, hey, we have very nascent AI. Once the AI catches up a little, I think we're going to have this path where maybe less math-oriented folks or folks who are less practiced in math can catch up and continue to have high earnings and be impactful. What are some of the futures that you see as it relates to high social, high math, your career, and maybe even tie that into advice for other data professionals out there?
I honestly think it's the missing layer for most data scientists or people who spend a lot of time on data. You can be incredible at numbers in the spreadsheet. If you lack the ability to translate those through language to other people who are non-technical, you're not going to succeed at the level that you want to. And so I think obviously the missing point in many of these data scientist skill sets is that translation. And so if you're a data scientist or a data professional thinking about this, or even a recruiter thinking about it from the other side, which is I need to get a little bit more mathy, but my superpower is my speaking and my ability to like wrap people up into a story. Couple things. One, spend like a little less time on the methodology. Some of the most boring presentations I've ever had in my life are from data scientists who spend the first 15 minutes telling you how they came to the number. And it's like, I don't even understand what the number is yet, man. You got to chill out. Like, we don't care about that right now. So make your point up front. And then if you need to explain it, this is a point of advice I often give to founders, which is they try to build a pitch deck and they try to answer every single question, whereas you shouldn't answer the questions. You should leave some mystery, have the person ask the question, and then flip to the appendix and say, we have thought of that actually. Like, here's the well thought out response. And you get that sort of credit of, oh, this is a thoughtful person who anticipates the flow of the conversation that we're going to have. The other really important point is, and this is true for recruiters and for data scientists, when you build an asset, a deck, a doc, whatever. You need to assume that you are not going to be there to explain it. So many people build things that, by the way they were built, require them to be in the room. Your best stuff is often going to be shared in rooms you're not in. So everything from the headline to every chart to the way that the deck is structured, et cetera, it has to be intelligible to people that are not going to have you there to explain it. And so if you have that as like a point of reference, what would this deck look like if I don't get to talk about it ever? I think that really helps you build better stuff.
That's actually a skill that I see a lot of big tech employees bring to early stage startups.
Yeah.
Or even if they work in finance, maybe they go to Wall Street and then they go to a private equity firm and then they go, deploy in operations at a startup. That is the biggest skill that I see assessed differently from folks that just go maybe right into startups and they don't have that big company training. It's how can you communicate asynchronously with a lot of clarity, structure. Love the point you made about being in the room with the VCs and being able to see around a corner and position the art of communication.
Yeah.
What's one thing you see recruiters get wrong about understanding equity?
This is a whole other podcast that we could do. I don't want to paint too generally, right? I don't want to have this broad paintbrush that says like all recruiters don't understand equity. What I am frustrated by, if you are recruiting for a startup that is, say, early to mid, so say anything Series B and earlier, seed A, B-ish, oftentimes you will default to talking about equity in dollar values. That is not only wrong, it's disingenuous.
Yes.
It is not true that the offer that you're giving this person is $100,000 in salary and $10,000 annually in equity. That is simply the 409A price multiplied by the share count. That is not what that actually is actually worth because you cannot sell it. You cannot go out and make $10,000 worth of value out of that equity today. What you're offering is a percentage ownership that could in the future be worth X given a scenario. And it's not easy to explain and it like muddles up the pitch, but it's more honest. And so I just want people, especially at seed stage startups, we see this all the time, where you get 1% of the company and it's worth today $200,000. And when we go big, it's going to be worth $2 million. And it's like, you can't just talk about it as though it's cash. You cannot sell this thing right now. And the lack of liquidity means you have to take a big discount on whatever that actual value is for the expected value over time. That is my biggest problem with recruiters right now is they treat equity as though it's money when it's an upside bet. And those two things are very different.
100%. We saw the rise of this probably back in that 2021 zero interest rate policy time where there was low unemployment, high competition for technical talent. Big tech was throwing monster salaries and startups had to compete in some way. And I think that muddling was how do we compare apples to oranges in total rewards, total comp packages, year one comp, the way recruiters talk about things.
Yep.
And somehow we got into this weird world where early stage startups, seed, Series A, they're dishing out spreadsheets with like financial modeling for employees. And it's just like what I was doing at that time was indexing on motivation. And that's the advice I still have for recruiters hiring talent in startups. Yes, exec search in startups, early stage, seed to Series B is completely different. The average rank and file employee in a startup at that stage probably should not be even thinking about equity in any capacity as the main driver for choosing that company. It's can you commit to this company for 4 years? Can you commit to the mission, the projects you're going to be doing? How does working with that company expand your personal network, the mentorship opportunities? This goes back to that list of 10 people, and it's this idea of the degrees of separation. Tech VC is a lot smaller than we think. That's what doing this show has taught me. That's what recruiting in tech has taught me.
For sure.
So I think the value in the long term is that network list versus that basis point or two of early stage equity that may not see liquidity ever. And if it does materialize, it could be 8 to 10 years down the line. And depending on if you're receiving RSUs, ISOs, there are very large tax implications. There are different dynamics in place in terms of triggering events that allow you to access that liquidity. I see startup employees have vested equity shares that they do not exercise because of that length to liquidity or an exit. You mentioned Carta itself being around Series G. What are you seeing in terms of comp packages for those liquidity events for companies that are working at blue chip household tech names that may not have offered liquidity to employees yet?
The weird part about it, and you're completely right that I think sometimes early stage employees can get overwhelmed with the equity side of things because it just feels like a whole other job of learning. I do love founders who talk about equity, not just during the offer stage. I often think that the only time that startup employees hear about equity is when they're being pitched on the job, and then it just is never mentioned again. Founders can do a lot more. Recruiters can be helpful in that in terms of the education process once they're in the company. To the idea of the liquidity timelines, you mentioned vesting and exercising. One of the craziest stats that we have on the platform is something like, this is today in 2026, something like 65% to 70% of all the options that are issued today will not be exercised by employees. So not only are they not money, they're not even given the chance to become value over time. The employee is saying, it's as though you never offered me equity at all. No thanks.
Wow.
Which is wild, right? Like that 70% is an incredibly high number. Now, most of that is because startups fail. And so, of course, I'm not going to exercise in a company that's going out. And then sometimes startups are overvalued. So a lot of those 2021 era unicorns, you're looking around you. So let's pick on a company for a second, like Clubhouse. If you worked at Clubhouse and you got an amazing equity package at a very inflated valuation, 2 years down the road, you see where the writing is on the wall for this business. You're not going to pay money for something you don't think is going to be worth money in the future. So you just don't exercise. I think that what the biggest change on that side is if you are part of the companies that are really crushing it, and everybody, you can list off the 10 to 12 private company names that everybody knows. Access to liquidity before IPO is actually a real thing now in a way that it hasn't been in a long time. So late stage tender offers, et cetera. If you work at SpaceX, that money, it's not public equity. It's not like it's on the stock market, but you can sell it if you want to. There's ways around it. There's opportunities. That is still a pretty narrow band of companies, but every year it gets a little bit bigger. And so I think that pre-IPO liquidity is a real thing for a certain segment of startup employees.
Do you have any data or advice around selling equity options to private companies in like a pre-IPO secondary market versus when companies offer liquidity events for employees and investors pre-funding round, pre-IPO?
Yeah.
Because I see a lot of that, and I think a lot of startup tech employees probably receive like a LinkedIn retargeting ad in their news feed about like selling their shares.
100%.
Like what is the actual data around selling, like clicking that link and selling it to somebody?
For sure.
Versus maybe your company offers a liquidity event to the 300 employees before their Series B.
Yeah. So the way that we talk about those two things is a company sponsored, typically a tender offer, but a company sponsored liquidity event versus what we call a bilateral transaction, which is you go out and find somebody to buy your shares. We'll talk about the company side first. So those are structured events where the company goes, we're going to offer a percentage of liquidity to our employees. Typically it's 20. You can sell up to 20% of your holdings because we've done really well. We want to get you some cash now. Great. My strong recommendation to employees is if you have the opportunity to participate in those tender offers, you should. Just because the world is uncertain. You're still going to hold a bunch of equity, right? You're only selling at most 20% of what you hold. And cash today is worth more than cash in the future, especially when that future is 5, 10 years uncertain. The bilateral transactions are weird. So sometimes they're very easy and you find a buyer on a broker-dealer marketplace and that buyer is serious and they want to pay a decent price and you go ahead and execute that transaction. The thing that you have to realize is that needs to be approved by your company. You don't just sell it. You have to get it approved by oftentimes the CFO or the CEO of the company. And they have right of first refusal and they can just say no. Many of them will just say no. Does that feel wrong of them to say no? You can say that. On their end, they're thinking, I don't want a price out there for my stock that I didn't decide on if I don't have to. Part of being private is I set the price when I can. 2, I don't want this random person on my cap table. I chose you, the employee, to own a portion of this company. I didn't choose them to own a portion of this company. Again, as a private company, that's part of the value, is I choose my cap table. So there are reasons why they might say yes or no to it. What's the annoying part is there are some of those transactions that are above board. And then there are just some like really shady characters that are trying to buy random startup equity and you don't know what it's for and you don't know if they actually have money to buy it, and you can like waste a bunch of time doing that. So I wouldn't, if you're a startup employee listening to this, I wouldn't go out and try to find a buyer yourself. I would use a marketplace if you need to. But just know that it's not a guarantee that you'll ever be able to actually transact on it. It requires permission from the company in most cases.
One of the trends I've observed in recruiting, when I look at a job description in the benefits and comp section of that JD, is seeing like 10-year exercise windows to give employees a little bit more time to make a major financial decision. The average rank and file employee is going to spend a ton of money, either cash up front or through taxes, to exercise their options. What does that 10-year window actually do for, say, director and below?
It's very meaningful. It just doesn't happen as often as you might expect. So the reason why 10-year is so different from the norm is that the norm is 90 days, which is you have 90 days to exercise your equity when you leave or the equity goes away. And that leave could be because you're leaving or because you got laid off. Companies that offer an extended exercise window, what we call a PTEP, a post-termination exercise period that's extended beyond 90 days. One, it's more common now. I would say 20% of offers have an extended PTEP. More common if you're an executive, for sure. Not always 10 years. Sometimes it's a year, sometimes it's 2 years, et cetera. What that does is it just kind of decreases the urgency, the acute problem that you might have of, if I get laid off, am I going to be able to buy this equity in 90 days? Am I going to be able to come up with the cash? And am I going to be able to want to spend that cash right now on this, especially with the emotion of being laid off or something like that? So it's a real meaningful, I think, improvement to employee lifestyle. I'm a big advocate for startup employees. I think they earned that equity. They should have longer than 90 days to exercise it. The reason it exists as 90 days, by the way, is not because founders are just terrible people. It's a tax treatment difference. So ISOs, it has to be 90 days. If you have it longer than 90, it flips to an NSO, which has different tax treatments. So there is some legal stuff in there, but I love the idea that founders should have longer exercise periods, and I'm glad that we're seeing that rise, if slowly.
Let's talk acronyms. What is the difference between ISO, NSO, RSU, and the different implications an employee might experience as they see those acronyms in job descriptions, in conversations with recruiters, in their contracts?
Yeah, most of the time they'll just kind of glaze over, right? And be like, this is gobbledygook to me. It doesn't matter, but it should matter. First off, if you're an employee and you're joining a startup, basically seed to late stage, most likely you're going to get an offer in options, incentive stock options, ISOs. Those, you can think of as effectively of having two criteria to become cash. First, you got to stay. You got to vest that equity, means you have to stay long enough, usually 4 years to vest the full grant. And then you got to exercise, which means I didn't get this equity for free. There was a strike price on it. I have to pay the strike price in order to buy those options and turn them from options into shares. So that's an ISO. And then it's taxed at the point of the spread between the strike price and the value of the stock at that point. NSOs, pretty similar, except for they have different vesting period treatments. Most of the time, NSOs are given to advisors, consultants, not employees. RSUs is the other big one. RSUs are restricted stock units. RSUs typically don't come into play until the company is pretty big. Call it $500 million or more in value. A later stage company will start to issue RSUs. Reason they don't do that when they're younger is because RSUs come with an automatic tax impact to the employee. You don't get to choose when you exercise an RSU. Whenever you vest it, it just exercised effectively for you. So you have to pay taxes on it. Obviously, sometimes at the earliest stages, you'd be paying taxes on something that doesn't actually end up being worth anything. So that's why RSUs are typically used later stage. RSUs are also very similar to the way that public tech issues equity to their employees. So it's a little bit more of a apples to apples comparison.
When we look at the time to liquidity for startups, .com era, there were blue chip companies IPOing in 2 years, 3 years. That is unheard of now. What is the average time from, say, like seed to IPO that you're seeing in tech?
From incorporation to IPO, it's something like 12 or 13 years. From seed, it might be then a decade. So this is a long, long time. And what's happening there is two things. One, IPOing has gotten harder. Yeah, it was a little bit better in 25 than 24, and people are hoping that it's going to be better in 26. Maybe we'll see some really big IPOs. It's still, you have to be a very big company now to IPO or to feel, there's no set bar, but it feels as though the bar has just gotten higher. And that means you got to be worth at least $1 billion, probably more than, considerably more than that sometimes, and be making serious money in terms of revenue. So you can't IPO as a Series A company or a Series B company. It just doesn't really happen, at least in America. So what does that mean as an employee? When you are joining a startup, you have to model out as though this equity is not going to be worth anything to you for a decade. Basically, anytime you join an early stage startup, which is why you should, again, not talk about it as though it's cash, because you don't have a lot of cash on you that you can't spend for a decade, right? Especially if that cash is unlikely to ever become real cash. So equity is upside. Equity is great, and ownership, and like we built a business around issuing equity, but it is not the same thing as cold hard money. And so you need to know where you are in your own financial journey and what you want out of work, because startups can be fantastic, but relying too much on the equity to like come through for you is a very difficult challenge.
I think about the implication of like that RSU modeling where you may have an incredible life-changing number of RSUs.
Yep.
And you pay 5 to 6 figures in taxes
Yep.
to potentially have liquidity years down the line. Do you have any data around that RSU vesting period to liquidity in later stage companies?
It's tough to model because different companies will achieve liquidity. And to be clear, even at late stage, the most likely path to liquidity is an acquisition, not an IPO. But if you're just doing an IPO, it still can be years and years, right? So that liquidity time window from the time you are issued that RSU until it becomes real money can be still incredibly long. And as you mentioned, there are startup employees that are paying 5 or 6 figures worth of tax on those RSUs in the hope that they become millions and millions of dollars once the company goes public. When it works, like if you were an RSU holder of Figma 2 years ago, it worked, right? You did the thing. But there are many, many, many other companies that were kind of like Figma 2 years ago that have yet to go public. You saw this actually with Airbnb and some of those earlier tech waves where the RSU window of expiration is usually 10 years. And they were private for so long that they were coming up on the 10-year window. And it was part of the reason why they ended up going public, was because they had all these employees that are like, you cannot let this lapse. Like, this is a major part of my family's finances. It would be unconscionable if this just went away.
Yeah.
So there's ways you can get around that, as sometimes reissuing grants, et cetera. But in general, that's the push. Like 10 years is a long, long, long time.
Are there any lending mechanisms in place for employees where maybe they do have RSUs at a Series D, Series E company, but that IPO window, like the investors, leadership, the board of directors is a little bit skittish to file the S1, where maybe they get a loan for $100,000 to pay taxes? Does that exist?
Yeah, it does. There's many companies, some small, some rather large, that will help you, what's called like stock option financing. Be very careful about that. There are really high character people that are doing this for the right reasons. Actually, it's actually a fun strategy on some of them. They want to own a little bit of these companies. So they'll say, pay the tax and then share the upside with you. So they own 20, 30% of the upside and you own the rest, et cetera. You have to read those documents very, very closely. You are, by definition, taking on debt in some of these cases to pay for an illiquid, uncertain asset. You do not want to be holding debt on something that won't ever come true. Totally fine to like think about how to finance those options. Just have a lawyer, have your financial advisor look at that. Like, don't just sign a company because you need cash today.
When I think about greater financial decisions, greater markets, real estate, you can get a 4 to 6% return. ETFs, set it and forget it. The George Foreman of financial growth for a lot of young people.
Yeah.
Do you think young folks getting interested in tech and startups, because it's such a part of our culture and our society, we're in SF, even the Uber driver has a startup idea. Is this something that you think young folks should actually think of as a financial vehicle? Or is there a more conservative approach to how they should consider spending their money or their earnings?
Yeah.
We talked about vestige. I think about employees who are saving that increased earnings that they've made by working in tech versus another industry.
Yep.
If they go all in on 100 Gs that they've spent 5 years, 6 years saving for illiquid taxes against stock units in the future. That sounds like high risk.
It is. If you just put your finance hat on, should most startup employees be considering themselves investors, which is what you are, right? Like a VC. You've effectively become a VC with one holding, which is your startup that you've joined. That is a very concentrated portfolio that is unlikely to be a good idea. So I certainly wouldn't spend more money on more illiquid stock. But you're also in this world, and I kind of feel for the kids growing up right now or coming out of college and into tech. It is a very odd world to be in where you can buy whatever you want in terms of meme coins, and you can't buy startup equity because you're not an accredited investor. There are so many misallocations of the way that the world works right now in terms of investable financial assets and non-investable financial assets. I think it's silly that you shouldn't be allowed to invest into startups, but I also think it's usually a bad bet unless you're very serious about evaluating these companies, treating it like you're an investor. So on the whole, probably I'd say personal advice, like be more conservative, right? Put that money into an ETF. But if you're working at a startup and you truly love it, you can take advantage of the upside.
Prediction markets, cryptocurrencies,
Wild, man.
sports betting. There are a lot of sexy shortcuts right now. What do you think it takes to be discerning at that investor level? You work with a lot of VCs.
I mean, if you look at the data, it would say that not a lot of VCs are great at this. I mean, which is tough to say, but look, you can look at it one of two ways. One way is to say VCs have no idea what they're doing, right? They're just taking random bets. Some of those bets end up, like 1 in 100 of those bets becomes Google. And so some of them do well, but it's kind of like luck of the draw. I don't feel that way. I do think that there's some persistence in early stage investing that makes you a great investor. The other way to look at it is that it's kind of shocking this ever works at all, right? Like the idea that I could put money into the QQQ, most big tech names, and sometimes putting money into a tiny startup that has 5 employees will do better than that over 10 years. That's shocking that it would ever work to that degree, but it does work sometimes to that degree. View it this way. There are millions of people who are trying to win the public stock market. If you are not spending every waking moment trying to outthink those people, you're probably better putting it into an ETF and riding what the market is, right? Outcompeting the market is very, very difficult. Outcompeting the market in startups is even probably harder because there's not as much information and all these companies might die at any time. So it's pretty risky. So again, when we get back to the biggest decision you'll make, which is do I join a startup or not? Joining for comp is not a great reason to join. Join because you love the space. You're incredibly excited about what it could mean for you personally, agency, growth in your career, et cetera. And join because, and this is something I don't think enough startup employees do, join because you think the founders are incredible. Evaluate them as people, right? No matter how big the startup is, the number one input to their success is who are the founders and how maniacal are they about winning. Do some actual evaluation of those people. If you're joining a seed stage startup, you're going to do that because it's you and 5 other people. So of course you're going to talk to them. I think at Series B, not enough employees actually think, who are the founders? And are they really winners? Are they in it for the long term? How do I feel about these people?
That's such great advice, Peter. When I think about the IPO market, we've seen fewer companies IPO.
Yep.
We're in the recruiting space. There are even fewer recruiting technology, software as a service companies that ever see an IPO. We're seeing more M&A activity heat up.
Yep.
We're seeing more roll-ups in the recruiting space for the larger human capital management software companies.
Totally.
Is that behavior and trend something you're seeing in other areas of the business?
Completely. I think that it is unlikely for a bunch of niche areas within private tech that you're going to see massive IPOs. The laggard for the longest time has been EdTech. Like when are we going to get a great EdTech company that IPOs? HR tech, as you mentioned, is not that far behind. There are some incredible HR platforms that but they do a lot of roll-ups. They're continually buying new softwares, et cetera. And then the idea of, do you have to expand beyond HR? The rippling idea of like, we do HR plus, we do all of these kinds of admin in order to be at scale and to get to an IPO eventually. I don't think that betting on IPOs in many of these categories is going to make a lot of sense. M&A is very real though, more real now than it's been in a couple of years. The more companies were acquired off of Carta last year than we've ever seen. So it is possible that your startup will get purchased. And then that purchase will flow to the common stock and make it a really fantastic wealth generating event. That does happen. Wouldn't hang your hat on it, but it does happen.
What do you think the difference is in exercising liquidity from M&A activity versus IPO?
IPO is still probably the gold standard in terms of like the percentage of wealth that's going to be generated in those events, primarily because you don't IPO without this growth story. Whereas there are reasons to get bought that are not necessarily growth, right? Talent, product, et cetera, that are a little bit less about the fundamentals of the company. There's also a lot of acquisitions, candidly, where everybody did okay, right? You raised $100 million. So if you get acquired for 150, you don't get 150 worth to give back to everyone. You give 100 to your investors and then you share the 50 amongst everyone else on the cap table. So there are some that sticker price looks fantastic, but given how much money they had already raised, et cetera, maybe the quality of that acquisition is a little bit lower than you expect.
Do you ever see 1x returns to VCs anymore for M&A activity, particularly for early stage companies?
If VCs are just making their money back effectively, then that was mostly a fire sale, acqui-hire sometimes less than that. If you have a Series Seed or Series A company that's being purchased for the talent and the tech, 1x is not a great outcome. And usually the VCs will make much more than that. Will it flow through to the common, right? So it would clear the liquidity preference of the investors and then flow through the common stock. My instinct is that only happens about half the time. I don't have great data on it. We're trying to work on that. Suffice it to say, if you just took everyone who said 2-time exited founder on LinkedIn and like dug into the exits, maybe it would not look quite as rosy as they make it seem.
What are we seeing right now with acqui-hires? We saw Scale get acquired in that dynamic.
There's a new thing. It's like acqui-hire licensing, where you don't get acquired. A couple of golden parachutes happen. So the founder plus like typically a couple engineers, maybe a dozen engineers, get purchased by Google. And then they just license the tech, but the company's left as kind of a shell. We've seen good and bad outcomes. So Scale is one, Windsurf is another. There's a couple other ones that have happened lately. A couple of them I think are whoever's left behind is really gonna suffer. A couple of them, it seems like the way that the deal was structured, it actually made everybody whole, and it was effectively an acquisition. They just didn't call it that because they didn't want to deal with the regulatory stuff. It does introduce this question, though, of if you're an employee and you do everything right, am I still going to get left behind? If I'm a growth marketer, I'm not going to get the Google offer, right? The engineers and my founder are going to get the Google offer, and I'm going to be left at a company that no longer has those engineers and no longer has that founder. Maybe I get paid out on my equity, maybe. That's kind of rough. It's a little bit of a break of the contract in startups in my world. So yeah, early stage founders are talking about it a lot.
What you just talked about is trust. And as we move to this future with AI taking over all of our workflows, there's so much speculation. There's a lot of whiteboard thesis happening right now around what is my job going to look like with AI?
Totally.
I always go back to trust. Do you have any thoughts around trust between the employer-employee relationship?
Employees oftentimes will feel as though they're kind of between a rock and a hard place. So say you're in a candidate negotiation and you're getting that little spidey sense. It's like, I'm not sure I trust everything. Or they're not being super open with me about what this equity means or whatever. But then you also think, am I going to ask these really difficult questions during this candidate process? Or am I going to get a red mark and not get the job offer? And those are real considerations. So I kind of put this back on the founder and the people at the company and say, it is your job to be as open and honest and like engender this trust from the very beginning as you possibly can be. And I do see founders who take equity seriously, who take the financial well-being of their employees as seriously as their own. Those founders don't necessarily avoid bad outcomes. They can still do layoffs and things, but treating people differently in those situations has long-term ripple effects, I think. I think trust is built off of all these little tiny micro interactions, and it's on the people who have the power to sort of build that trust amongst the employee base.
Peter, we're out here at Carta's headquarters, downtown SF. You're in the office a few days a week. What types of roles are you hiring for?
Yep.
And why should somebody join Carta?
Lots of different roles. Engineering, fund accountants, fund admin. I'd say join Carta for 2 reasons. The first is that you are going to be at the heart of private capital. So if you care at all about VC-backed startups, private equity roll-ups, private credit, this like giant world of everything that is not public, Carta sits in the center of this web. So if these are exciting topics to you, there is no better place in the world to learn about them. The second is that we are really highly focused on earning the right to solve the next problem. So problems are the sort of unit of work here. We organize ourselves around problems, and the reward for solving a problem is getting to solve a harder problem. So if that sounds like you, if you're like inherently cross-functional and problem solving and not super focused on job title, but super focused on winning this problem, we're a great place to be.
All right, we're going to wrap this up before we do.
Yeah.
Close your eyes for a second. Tech removed. What's a major real world problem that you would love to solve if we took this VC money and put it in the real world?
So VC doesn't count as the real world.
No, not in this scenario.
Not in this scenario.
Physical world, humanity.
Yeah.
What's a passion area that you would love to see all of this wasted VC capital that goes to zero, that's just lit on fire? What's something that you would love to see solved?
I think we could spend a lot more money, time, and effort trying to solve local governance problems. So how do I interact with my municipality? How do I interact with my local school district? How do I think about local zoning laws? When you're in San Francisco, obviously the biggest conversation is always about housing and like what goes on there. But there's 100 adjacent conversations where it's like, we don't want to solve this at a national level. It's you and the 45 buildings next to you that comprise your neighborhood. So like, how do you build better systems to have everyone involved in those discussions and like make progress on local governance, I think is a place where I would spend a lot more money.
Amazing. Peter, thank you so much for having us out. This is a wonderful conversation.
Cheers, man. Thanks for coming.